Good morning, everyone. My name is Jason Collins with URL Insurance Group. I'm an annuity and life insurance specialist here at URL, focusing in single premium life, traditional life insurance, annuities, and long-term care. First off, I'd like to thank everyone for taking time out of your busy schedule to be with us today. Those of you that are currently doing business with URL, I'd like to personally thank you. We understand that you have so many options as to where to place your business, and that's why we appreciate you working with us at URL, and we promise to continue our dedication to your success. Some of you on the call today, you're new to URL, so I would like to welcome you. What we are is a full-service, family, nationally owned broker that has been working with agents like yourself, offering back-office support for over 35 years. Like I discussed, URL provides single premium life, fixed and indexed annuities, traditional life insurance products, as well as individual and group health products. We also have a senior division that offers MedSup and MedAdvantage products. So take a moment after the webinar, kind of kick around our website if you want to see if there's any other areas that we could help you out. Our website is www.urlinsgroup.com. URL also has a division called our Orion platform. So basically, in its simplest of forms, the Orion program provides agents like yourself an opportunity to generate business in areas that you've traditionally passed on. A lot of times we'll see it in the annuity world that if somebody is, a Medicare heavy agent and they come across an annuity or a long-term care client or opportunity, and either they don't want to go through the CE credits of maybe doing the long-term care or the any sort of back office testing that you have to do for annuities like the NAIC, what they'll do is they'll reach out to us, and then we will see the sale through from soup to nuts and then pay you as the agent for a referral fee. It'll be kind of a split comp. So again, take a moment after the call here today. Check us out, www.urlinsgroup.com. So for those of us on the call today, September is Life Insurance Awareness Month. I'm extremely excited to present this single premium life scenario. We've all seen recent world events that are affecting people's hard-earned money. And during this time of uncertainty, those that have protected themselves and their retirement portfolio have positioned themselves for a strong and vibrant financial future. The question is how to pass on wealth to the next generation in the best way possible. Well, the answer to that is life insurance. So those of you that are having the conversation right now will be on the forefront of this massive wave of sales. So we're going to discuss today how single premium life can fill those portfolio gaps with your clients and turn a potentially bad situation into a breathe easy moment for them and their families. So I'd like to mention before we get any started, if you have any questions during the broadcast, there is a question box on the right side of your screen. Just type in the questions and we'll answer them towards the end of the program. All right. So let's get started. So what is single premium life? Basically single premium life is a life insurance policy that only has one large upfront premium payment that will generally last your entire life. So when you're looking at a single premium life, you have options for a whole life single premium life. You do have an option for an indexed universal single premium life. Those offer guaranteed floors, plus they're attached to the S&P, so there's some potential growth there. But some clients just like I want to put my $100,000 in. I like to know that I get X amount of dollars of death benefit. It's all guaranteed. That's what I like. So we have those options for you. A lot of options for your clients, depending on, what route they want to go. So fact finding is always key to success. So that's basically single premium life. I wanted to touch on too, because the hybrid life long-term care a lot of times go with single premium life conversations. So instead of doing the traditional hybrid use it or lose it long-term care, people have been getting very creative with saying that they have, again, $100,000 worth of money that they want to put down. And that could generate not only a life insurance benefit for them that they could pass on to their next generation, but it also does protect them should they run into any sort of unforeseen health issues. So they could use it for chronic care, terminal care. You can get paid out in one lump sum. You can do monthly installments. So it really is a creative way to protect clients' assets should they come across any sort of unforeseen health issues. So I like to say single premium life is really a use it, give it, and get it back. right? So anytime I buy something, I like to make sure that I'm going to be able to use whatever it is that I'm buying. If I can't use it, I want to make sure that I can give it to my kids or family members or friends, and maybe they'll be able to use it. And if nothing, all else fails and I can't use it and I can't have friends or family use it, I want to make sure that I'm able to get my money back. So that's what Single Premium Life in 2025 is able to do for you. You're able to use it, your clients are able to get it, and they're able to give it back if something better comes on the market. So let's touch on the use it aspect of the Single Premium Life. So we talked about the protections from LTC concerns. They're able to accelerate the death benefit for a chronic care, nursing care situation. The triggering effect is the client can't do 2 of 6 activities of daily living. Once that is established, the company then will start sending out, you would submit the paperwork and then the company would then start sending out the installments, the monthly installments. Some keys, buzzwords that I always like to mention. Make sure you know the difference between indemnity and reimbursement. Indemnity means that whatever they say the carriers are going to provide you, let's say they tell you that it's going to be a $5,000 a month long-term care pool money, they're going to send you a $5,000 pool of money. If it's a reimbursement, the client is in charge of paying for it up front, and then the company will then reimburse for all qualified expenses. So it's important to know the difference between indemnity and reimbursement plans. You have access to your cash. A lot of the carriers will allow up to 10% free withdrawal from the accumulation value each and every year. So that's fantastic if somebody wants to go on vacation or has a major expenditure, like maybe has to put a roof on a house or something. The client has access to the cash. So that just doesn't sit in there and it's locked into this vault and they can't touch it. They do have access to the code. Again, we talked about the benefits would be generally tax-free. That's why life insurance is the best way to transfer wealth from generation to generation, because it is tax-free benefits. And here's another wonderful, simplified issue. So the average age of the Single Premium Life, I'd say, is about right around 72. So they've seen it. So it's a series of maybe 15, 20 health questions. And assuming that the client can say no, then you can proceed with the application. Some carriers have a little bit more of a long-term care aspect to it. So there might be a phone conversation with an underwriter. But what I will say is that you're not going to have to worry about doing any sort of parameds, exams, having anybody come out and poke and prod your clients, either giving blood or urine or anything like that. So it's a very simplified issue. All right. So that's the use it. The give it, obviously, we talked about that. This is life insurance. This is the best way to transfer wealth from generation to generation. So it's going to provide a higher death benefit than the premiums paid in. We talked about the tax-free family legacy, and it also avoids probate. That's important. It stays outside, so you're not having to pay for, your clients aren't going to have to pay for any sort of lawyer fees or anything like that. Everybody fighting it stays outside of the probate. So that's the give it aspect of it. The get it back, full return of liquidity. So if that's an important feature to your clients, some carriers are better than others. Some will give full return of premium from day one. Some like to sit on it for about 5 years, and then you have the availability for full return of premium. So if that is a driving force, make sure you're aware of that, and we can cater the companies and the carriers to that. Honestly, it's very rare that people exercise the full return of premium from day one, but I have had conversations to where people like the idea of just having that rider on there, and it's free. I say a rider, but it comes with the built-in, caked into the policies. But some people just like the idea that, if all heck starts breaking loose, I'm able to get, or something better comes out on the market, I have access to my cash. I'm able to take my premium. Sometimes there might be, a little bit of growth to your premium as well. So if it's in an indexed universal life, that cash value could creep up and be actually higher than what your original premium was that you paid in. Some carriers provide a bonus. So I know there's right now, Equitrust has a 15% bonus on their Wealth Max product. That's been real enticing for people, agents like yourself, to be able to go in there and say, here we go. We're going to add a 15% on to the premium that you're going into this. It offers full return of premium. It has the living benefits. It offers a tax-free death benefit. So it really is a truly use it, give it, get it back, because if the clients have the funds, there's no real downside for them. They're able to use it in a multitude of ways. It's just a matter of people don't know that these products exist. So, that's why we like to get in here. We like to talk about these things, put it on the forefront of everybody's mind. And because, again, people don't know what they don't know. So it's wonderful to have just the conversations, or at least be in the back of your mind, oh, this could be a good candidate for a single premium life product. So let's talk about some of the pros of the single premium life / hybrids. Again, the single premium life, hybrids, they all have the long-term care, tax-free wealth transfer. So no future premiums needed. The cash value builds over time. We keep harping on that tax-free death benefit. Again, that's a lot of times that's what we're talking about right now, transferring wealth. So you're able to, and I'll have an example here in a little bit. The living benefits, again, we talked about having the long-term care coverage. Equitrust does have, I go back to Equitrust. They have a really nice product. I talked about the Wealth Max. They also have what they call the longevity benefits. So not only do they have that long-term care chronic rider on it. When it's life insurance, you can't say long-term care. It's more chronic rider, but they're essentially work the same way. But what the longevity benefit means is that your clients, there's a few caveats to it. The policy has to be in place for 15 years. They could have never have taken any sort of money out of it. So no, vacations, they take 10% out, no, putting roofs on, and they can never use the chronic rider. But assuming that all that is in, so 15 years it's in force, they've never used the money. And I think the client is 85 or so, but they have access to accelerate it for income as well. So that's a new feature. There's nothing else like that on the market that I'm aware of. So they're able to really use it as far as income in their older age. So it just doesn't have to sit there and really use it. And again, going back to the simplified underwriting as well. Real big pro. That's actually one of the bigger pros of a single premium life is the underwriting aspect of it, because some of the carriers, you're going to be able to get an answer within and an approval within minutes. 5-10 minutes of submitting the application. So you'll be able to know right there on the spot if you need to pivot and go in a different direction. So some of the cons, I always like to talk about the pros and the cons. Single payment's not for everyone. We understand that. If they like the idea of the single premium life, they like the concept of being able to use it, give it, get it back. We also have carriers that will take recurring premiums. So you can choose a 5-year premium payment, a 10-year premium payment. Depending on the age of the client, you can go to age 65, premium payment to age 65. Some carriers have a pay to 100. So even though they say single premium life, we can get creative with some of these to where you have the benefits of the single premium life, but yet you're able to expand that premium payment over a period of time. The surrender charges, some people look at those and they say, okay, well, there's some surrender charges in here. Well, if that's a concern, well, then I would look at the full return of premium options, because what will happen is the surrender charges go away and you will be able to get 100% full return of premium from day one. So again, it's all about the fact finding, understand what understand what your client's looking for, kind of their pain points, and we would be able to find a solution for you, I promise. So Mike asked a question here. Is the cash out in the longevity rider treated as an annuity or fully taxable? That's a good question, Mike. I'm going to have to get back to you on that. I know with the long-term care, they don't tax it. With it being a life insurance, from my understanding, it is not taxable, but I'm not a CPA. We always have to kind of throw that caveat out there. So I will find out from from Equitrust on exactly the verbiage of how they treat that. I do know that if you take money out, if you surrender the policies and there is gains, you're taxed on the gains. Obviously, these are MEC products, so there is a slight taxable. But as far as the longevity rider, that's a very good question. I might have to get back to you on that. So I will get back to you on that. So moving on, here's a sample scenario, right? Female age 65, she puts in $100,000. She's got a guaranteed day one death benefit of $180,000. So right there, she's able to generate $80,000 worth of tax-free death benefit for her loved one to be able to transfer that wealth over to her, husband, wife, grandkids, whoever, kids. And you can see in this scenario, I did an indexed universal life. So in year 20, it actually has grown up to $268,000. So again, that's pretty good. You're taking your $100,000, you're passing on that wealth, all tax-free to your loved ones. And then in the cash value, that following line there, the year 20 non-guaranteed cash value, that's the amount of money should they want to surrender the policy. Now, again, we talked about the taxation there. $100,000 goes in. It had grown to $229,000. They would be taxed on the difference, assuming that they just offer the full return of premium feature from these products. So just something that I always like to throw out there. So pretty good. 180 right out of the gate. $80,000 in bump in value right out of the gate. It's pretty good. We talked about the long-term care. I always like to touch on this. I know this is a wealth transfer conversation, but the same kind of scenario, female age 65, single premium life premium payment goes in $180,000. The death benefit slightly actually higher in that in year one, $228,000. But the long-term care pool of money is really where you're going to be looking at that play is $418,000. So now I will tell you $228,000 to $268,000. So again, we always like to run a couple scenarios between the two, give you all the pros and the cons of each. We're here to teach. I'm not going to push you in one way or the other. I'll give you all the options and let yourself, the client, decide on which route that you want to go, depending on what their concerns are. So, who are the candidates? Anybody who's interested in long-term care, certainly. Anybody who's interested in estate planning. Anybody who has RMDs or qualified money. This is actually a big one right now. Baby boomers are starting to get into that phase of their life where if they have any sort of qualified funds, they're going to start getting to that age 73 to where they have to start taking money out of this. They can't let it sit there and grow anymore. Well, we have seen where people will take that qualified money and purchase a single premium life product. And we can do that. We do have some carriers that will accept qualified money, and then all the taxation and all of the moving it from qualified money to non-qualified money, it happens internally within the product. We've seen a lot of sales with that as well. So that's a really good feature. RMDs with qualified money. We're at that age now where you're starting to get more and more of those conversations. So instead of them, my parents, what they do is, and it's wonderful, they get their RMDs and they buy their grandkids, my kids, when they graduate high school, they get a car. That's awesome till you get the insurance bill, but that's awesome for the kids. So, but eventually they're going to run, there's only 5 grandkids. They're not going to know what to do with it. This is a conversation that I've been having with them. Why don't you now start protecting yourself, taking that money? That's wonderful that you bought the cars for the kids. We appreciate all that. They definitely like it. But let's just start protecting yourself for any sort of long-term care needs or transferring wealth onto myself or the kids. They would love, they love a car, but they would love, some tax-free death benefit as well. So those are some candidates. So how do I fund some single premium life hybrids? So these are, if you get into any sort of conversations with your clients, it doesn't matter if it's a Medicare client or if you're doing a client review. Cash value from old whole life policies. Again, we see that a lot. Folks have raised their families. The houses are paid off. They don't need those huge whole life or universal life insurance products anymore. But there is cash value in that. And, they're continually paying every month or every year. They're paying into it. They don't need it like they did when they were in their 20s, 30s, and 40s. So what people have been doing is they take that cash value from what they've paid into in those old whole life policies, and they 1035 exchange that single premium into a single premium life. They're able to protect themselves. They're able to pass on some money to their loved ones. And you as the agent are able to eliminate monthly or annual premium payment for your client with no out of pocket for them. So we see a lot of sales from that way. CDs, certificates of deposits. What are they making right now in the banks? 1, 2, 3, 4%. Maybe not even that much. If I see somebody who has CDs in their portfolio, I always ask them what they're earmarked for. If I hear that they're earmarked to just give to to somebody, boom, I hear that is a single premium life conversation, because you're now taking that CD out, you're funding it into a single premium life, all tax deferred. If they take the money out of it, if they surrender it, certainly tax free. If they pass it on to the loved ones, they pay taxes on those CDs annually. So that's another creative cost adjustment that you can provide your clients by taking that CD and moving it out of there into a single premium life. It's very beneficial. Retirement funds, we kind of talked about that. I know for myself, somebody has like a 401k and they don't necessarily need it. They're good. Boom. Let's move that 401k from your previous job that you don't really need so much. Let's move that into a single premium life. We talked about RMDs and then savings. So these are something that, you just got to make sure that they have the funds available. What I don't like seeing is the last little $50,000 that somebody has in their checking account. Let's try to get a single premium life. I don't know, maybe take 25, maybe take 20,000, something like that. So the savings accounts definitely is something to keep in the back of your mind. So here's just some stats. We had talked about the average size is 81,000. Most of the gender is female that is purchasing these things, especially when you start talking about long-term care having a component in this. I was actually just out in Pittsburgh. I have one living grandmother still. She's 94 years old. And my grandfather had suffered from MS. And what happened is she was the caretaker. They didn't have long-term care insurance. She was the caretaker. He had MS. I don't know. She was, 105 pounds and he was 200 something. And he would fall in the shower. And now she would have to she couldn't pick him up, quite honestly. And so she would have to call the fire department. They would have to come out. They would have to pick him up. And it was just an embarrassing situation for my grandfather, for my grandmother. So it really resonates with female. Females tend to look at it more emotionally. We males look at it more logically. Oh, we're never going to go into a home. We're going to be fine. My wife, my kids, they're going to take care of us. Well, yeah, that could be the case. But what about the emotional burden that's going to go on the family members that have been taking care of the sick? So you want to try to look at it as more of like an emotional versus logical thing, when discussing this with your clients. Yeah, it may never happen. You're right. Mr. Jones, you may never go into a home, but wouldn't you like to protect yourself? And if you don't go into a home, wouldn't you know that you're taking this money and passing it on to your loved ones tax-free? It's just a win-win all the way around. Here we go, the source of funds. You can see the big one is CDs, savings accounts, that sort of thing. Age bracket, the average age we discussed is 72. So it really is the older generation that is purchasing this. Again, they've made their money. The houses are paid off. They don't need the huge amounts of life insurance anymore, but they do like having something. So simplified issue. It's great for somebody in their 70s. They don't have to worry about going to the doctor's office. Sometimes it's a telephone call. Sometimes it's not even a telephone call. So it's a wonderful product. So just moving on. That's pretty much it. So thank you so much, everybody, for joining us today. I don't see any other questions. I'll certainly, Mike, I will follow up with you on that, the cash out longevity rider. I'll get some more clarification on that. I do have a question. Is there a limit or cap from Denzel? Is there a limit or cap to what a client can put into the policy? I deal with a lot of clients. Sorry, I'm getting a phone call. I deal with a lot of clients who are very well off and always wonder about not losing it. So there is a limit. So depending, Denzel, that's a great question. Depending on the carrier, $750,000 worth of premium paid in is one that is just jumping off onto my brain. Some carriers do it differently. Like they don't necessarily, some have their maximums by the amount of premium going in, and some have their max by the amount of insurance that they're buying. So there is it, but they're pretty large. And quite honestly, if we have a client that, let's just say, has $10 million and, we'll piecemeal it between the maximum with this company, we'll call to try to get, how much of exception that we can get. Sometimes some carriers will allow to go above their maximum. So that's a phone call that we would have. But let's just say, for example, that doesn't happen, and they say, nope, the maximums are what the maximums are. We definitely have it to where we would go, okay, we're going to do a portion in this company, a portion in this company, a portion in this company. These are the bells and whistles and the pros and the cons of each one. So we've done it in that way as well. Michael says, can we get the slide deck? Yes. So what will happen is, after the presentation, everybody who has signed up today is going to get a copy of this presentation in their email. So just make sure you take a look for that. So Michael, you guys, everybody will get the presentation in the slide deck. So with that being said, I just want to thank everybody for being on the call today. Just as a reminder, we do have, this is the first week of September being Life Insurance Awareness Month. We do have a series of 3 more weeks of webinars. On September 11th, Matt's going to be talking about family protection. On September 18th, Steve is going to be talking about business succession. And on September 25th, Matt will be talking about final expense. And in the meantime, if you have any clients that you're interested in getting some illustrations for, some information for, my phone number right there, that's my direct line to my desk, 717-216-8038. You can also email me at jason.c@urlinsgroup.com. I'll be more than happy to, certainly get you any information, answer any questions for you. Again, I'm a believer. We know what we know, and we can't know everything. So please feel free to call me. We'll have a conversation. There's no such thing as a silly question. I just want to make sure that everybody, not only you feel comfortable presenting these concepts, but I also want to make sure that your clients feel comfortable with what they're hearing and what they're purchasing. So again, utilize us here at URL. We're here for your success. We appreciate everybody. I appreciate you being on the call today. And again, have a wonderful, it's September weather out here. It's the best time of the year for me. So, and football starts tonight, which is also a good thing. So if you guys have any football fans out there, good luck to your teams. Have a great day, everybody.